Welcome to Inside India. I'm Amitabh Singh, and at this hour, these are your headlines. India markets poised to open lower today following steep losses across Asia. South Korea's Kospi sinking nearly 10% as the conflict in the Middle East continues to just rattle global markets. Part of that sell-off due to worries of energy shock, production and exports across the Middle East coming to a standstill, sending oil and gas prices to one-year highs. Explosions continue to rock Tehran even as it expands attacks across the rest of the Gulf region. The US and Israel say they have struck nearly 2,000 targets across Iran. It's 11 a.m. in Singapore. Asian markets at this point in time looking like this. Well, a sea of red as expected, tracking the wild session in Wall Street, where all three major indices fell almost 3% but bounced back to settle 1% lower. In Asia, it's South Korea, of course, that's leading the losses. The Korean exchange briefly halting trade earlier this morning after steep losses. And at this stage, it's down 9%, perhaps a little bit more. We're watching that 9.5% now. The index now down over 15% or so week to date as sectors exposed to Iran like shipbuilding stocks have dropped sharply. Obviously, the tech stocks also hit really hard in South Korea. Eyes also on China, where investors will be watching the annual parliamentary meeting by China's policymakers later today. Hong Kong, Australia, Japan also down. Interesting to see that Japan is down nearly 4%. This as oil prices in Asia trade continue to rise unabated. Brent going past, well, nearly 82 now, going past 81 some time ago. Its highest level since January 2025. And WTI above, was above 75, just below that right now, and shaking up really the oil markets. This as the reality around the Strait of Hormuz becomes even more concerning as we keep tracking the developments. The conflict between Israel and the United States and Iran escalating with fresh strikes hitting targets across Iran. Lebanon has also been pulled deeper into the widening Middle East war. And CNBC's Dan Murphy has been tracking all of this late last night and early this morning. He's joining us from Dubai with the latest. Dan, just give us what you know so far with so much information coming in so many asymmetrical ways.
Amitabh, good morning to you. Well, let's start here in the UAE, where authorities say drones actually struck the US consulate in Dubai overnight. We have seen reports that social media video is actually circulating online showing what was a plume of smoke and a very large flame above the consulate compound in Dubai. And of course, this also resulted in a fire that has now been put out. There were no injuries, according to the Dubai media office. At the same time as well, what we've also seen is the UAE saying it has not changed its defensive posture despite what was a wave of Iranian attacks across the country. Officials here in the UAE actually saying more than 1,000 attacks have taken place since the start of the escalation, a total that they say now actually exceeds the amount of strikes targeting all other countries combined. Amitabh, as you said earlier, we've also now had an update from the US with regards to where we stand in this conflict. US officials say the strikes on Iran have already surpassed the scale of the 2003 shock and awe campaign that actually opened the Iraq war back in 2003. A senior US commander saying the first 24 hours of this operation were nearly double the intensity of the initial assault on Iraq. He actually said that US and allied forces have hit some 2,000 targets inside Iran, and 17 Iranian naval vessels, including a submarine, have been destroyed. But of course, the major focus for the markets and market investors right now is on the Strait of Hormuz, where President Donald Trump says the US Navy could begin escorting commercial tankers if necessary, after we saw threats from Iran to set fire to any ship that attempts to make this crossing. US officials say it has now been cleared of Iranian vessels. And in a post on Truth Social, the president said the US would ensure what he called the free flow of energy to the world, also saying that Washington could perhaps provide political risk insurance to support maritime trade moving through the Gulf. And of course, this is absolutely critical. Roughly 20% of the world's oil supply passes through the strait, and the president may be seeking to avoid an energy and inflation shock ahead of the midterms. a recognition here that this conflict doesn't just hurt the oil producers, it also has the potential to hit the gas pump and the grocery store at home as well. And as you mentioned, energy prices have been surging as traders weigh the risk of a prolonged disruption to global oil supply. For now, though, the situation is, of course, extremely fluid. We're seeing military operations expand across several fronts in the Middle East, and of course markets also hanging in the balance here. Amitoj?
Dan, that's great reporting. Please stay safe out there in Dubai and continue to bring us that coverage at the same time. It's brilliant coverage. Thanks so much for that. Now, the Indian markets, they come online in about 40 minutes. Here's what GIFT Nifty futures are indicating at this point in time. As expected, it's going to be a lower open, almost below 24,500 when it has been at 24,865. It fell below the 25,000 support mark earlier on Monday, of course. Yesterday was a holiday, and while traders will be back in action, the key is still one of the most important holidays on India's calendar. Does it really stop traders from selling given the Iran conflict? The likely answer, according to traders, is that the bearish tone will continue from Monday with the rupee breaching the psychological 92 at this point in time, 92.06. Exporters perhaps smiling a tad bit, but overall it is looking bleak, and we'll have to wait and see whether the central bank in India does a little bit more of intervention as traders have been suggesting. Now, the markets will give a read of how vulnerable India is to the conflict in the Middle East, as today will be day 2 of trading in India since the conflict began. And the one area where there is a lack of clarity: how many days can India go without oil supply coming in when it imports nearly 90% of its crude oil? That's the big question. First, let's just break down why this is a concern. India imports 55% of its crude oil need from the Middle East. With the Strait of Hormuz effectively closed, India does need to diversify sourcing that 55% from other nations and do it rather quickly. India had reduced its purchases of Russian oil from about 35% to 20%. Sources suggesting India will certainly do so. They will buy Russian oil at this point in time, even if they perhaps need to negotiate with the US on that, and we don't know how that's going to pan out. The Ministry of Petroleum in India has not said so officially, but then it has maintained stoic silence or ambiguity about Russian oil for quite some time now. The Minister of Petroleum and Natural Gas, Hardeep Puri, he did brief the media, although there was no audio or video recorded. The oil ministry released a statement saying the country is well stocked and has access to cargoes not routed through Hormuz, but it hasn't disclosed how many days of reserves it holds, and that's key. Several reports have emerged reflecting that, some ranging it at about 2 weeks to as much as 60 days, and our reporting is suggesting it's about 4 weeks. That's a fair assumption. This is obviously the case if no supply of global oil comes, but our sources telling us that India's oil marketing companies are definitely scrambling to find the best price, shortest supply chain, and are in a bit of a spot to make a decision on that. In all of this, Russia says it's ready to fulfill India's energy demand. Now consider what India's foreign ministry said. This is critical. As a proximate neighbor with critical stakes in the security and stability of the region, these developments invoke great anxiety. Our trade and energy supply chains also traverse this geography. Any major disruption has serious consequences for the Indian economy. And let's just quantify that. Indians from the largest population of expats in the Gulf. That's key. More than 2,300 containers are stuck at different ports right now that are related to Indian businesses. 400,000 metric tons of Indian basmati rice backed up at ports. Remember, 80% of India's basmati rice exports go to the Gulf, 35% to Iran. Containers carrying frozen foods and perishable goods particularly, they're just standard. And we haven't even got down to speaking about LNG and LPG. India does not have strategic reserves for either of these, and that's why reports saying that India is already reducing nat gas supplies to its industries to preserve these resources. To talk about this and more, we have Shumita Devashwar. She's the chief India economist at TS Lombard. Thanks so much for taking time out during a holiday time, Shumita. We really appreciate that. That is quite special of you. I want to start by just understanding your perspective on one aspect. Given that the conflict is now looking like it may last a few weeks, if not months at least, what is your assessment of the impact of a prolonged period of elevated energy prices on India's macro fundamentals?
As you said, that India is so dependent on energy imports. And what had been happening because of US pressure is that we had been moving towards West Asia, away from Russia. And now it seems that that's going to have to change because of what's happening in Iran. So this is very concerning. We're already seeing the rupee at record lows again. Just when everything seemed to be working out okay because the trade deal was announced with the EU and then the US back to back, and that overhang from the markets had lifted. Now we have this to contend with, and this is, of course, I mean, because India is such an oil import dependent economy, that this is a very big concern for the macro.
Okay, how does India or the government, I don't know, RBI, how does it respond to this macroeconomic challenge? Do you anticipate fiscal policy, fuel subsidies to do most of the heavy lifting in time to come?
Yeah, so we have seen, as far as petrol pump prices are concerned, diesel pump prices are concerned, that the government hasn't changed prices since October of 2024, even though they have been deregulated. And basically, in times of good prices, when prices are low, the government is actually filling up its coffers, and when the prices are high, then the government can absorb some of that shock. It really depends on how long this conflict continues. As you said, that that we don't quite know how much India has in terms of its strategic reserves, but 4 weeks, I think, as you mentioned, is a good estimate. But what happens beyond that? And so we have that period now to scramble and get our oil supplies, try and get something in order. But there's definitely going to be an impact. One of the biggest things, of course, is oil prices also going up. And even though it doesn't affect the consumers directly at the pump, but there are all sorts of spillover effects in terms of logistics costs and what happens to also our export market, what happens to remittances from the Middle East, which form such a crucial source of foreign funds for us.
I want to just dive a little deeper into crude oil because, as we know, in January and perhaps in February, we were awaiting that data. India buys about 55% of its crude oil need from the Middle East for these past 2 months. That stopped. Even if it does diversify, it's almost certain that India would need to buy from Russia to offset what it can't get from the Strait of Hormuz. And sources I have spoken to, they've not ruled that out. This is both private and sources close to the government. Analysts are saying that India will buy from Russia for sure. Does that make you worry a little less about India's import bill?
Yeah, so as I said, we really have to see how this plays out. That I think that India was able to make this switch quite fast from Russia to West Asia, and now it has to do the opposite. And I think that that it will be able to do so. I think what comes down to it is how long this conflict continues. Because how much are we going to import from one nation, right? Even at the peak, Russia was supplying 40% of our import basket. So are we able to get 100% from there? Of course, we are seeing volumes from the US and Venezuela also pick up. So I think that there are various options to work with, but if we are going to assume that India is not going to be hit by what's happening in the Middle East, that's not possible, because even when we were importing such large quantities from Russia, we were still dependent on the Middle East for about as much the combined share was pretty much as much from the Middle East.
Yeah, I was speaking to an analyst earlier, and he mentioned that India's demand is 5 million barrels per day. And if this situation continues, it's at least going to need about 2.5 million barrels. And the rest of the world has the potential to only incrementally increase their production capacity to about 2 million barrels. And there are other Southeast Asian nations also trying to get hold of those 2 million barrels. And they are more dependent on India, on the Middle East. You mentioned this, so I want to bring this up. There are 9 million Indian migrant workers in the Persian Gulf, contributing about 38% of all remittances, a big part of India's economy. The most number of expats in the Gulf come from India. You mentioned remittances, so I want to understand your worry about the impact on remittances for India.
Yeah, so the remittances from the Middle East, they account for about 38% of total remittances. India is the largest recipient of remittances in the world. There is a very important source of foreign flows, and just in the economic survey that the government had released in January, there was a whole section on it, and it even described how the remittances are a bigger source of foreign funding for us than FDI inflows, and how they fund about half of India's merchandise trade deficit. So, an impact to these flows because of the conflict, because of the sectors that a lot of these people living in, a lot of Indians living in the Gulf are engaged in, like construction and the oil services. That is going to obviously impact the remittances that flow in, and with wider consequences as a result.
Just talk to us a little bit about the rupee and the downward pressure on it and the upward pressure on bond yields. This renewed pressure coming on the back of a period when both assets were already underperforming. If one has to take an optimistic view and believe that this conflict will end quickly, what does that imply for the rupee and Indian bonds?
So as I said, I think that before this conflict broke out, we were getting more optimistic on the Indian economy, that, with low inflation, a fiscal relatively well in control, with the government looking at, public capex push. And also, we've also seen signs of an investment, long-awaited private investment revival happening, the early signs of a pickup. All that has been thrown, out, basically blown out of the water because of this conflict. We've seen the rupee now at record lows. There was always pressure on the bond yields because the government borrowing program is still large, because the states are borrowing a lot, even though the central government had been narrowing its fiscal deficit. So if the conflict gets over quickly, then I think it will be back to business as normal. But right now, there are just too many questions open, and that's going to hurt the private investment revival. That uncertainty is the last thing that we need right now.
Right. Do tell us where you see the rupee going in about a month if the conflict is not resolved. And in terms of all of that, I want to ask you about AI and the risks to India's IT sector. Assuming that the rupee climbs to potentially 93 the way it's going right now, would that be a blessing in disguise for this sector? How do you see the relief to this and other sectors?
I don't think that we can really call it a relief, even if the rupee weakens a lot. I think that there are going to be more concerns about the rupee weakening on the import bill side, because if there is, a hit to the global economy, you talked about an inflation shock, then where is the demand going to be there for IT services anyway? So I think that the conflict overhang is very detrimental to the macroeconomic outlook in India on all fronts.
I want to talk to you about the US-India trade deal a little bit. Christopher Lando, the Deputy Secretary of State, US, is on a visit to New Delhi for the Raisina dialogue. And so my question is, has the conflict in Iran now derailed those negotiations to such an extent, perhaps more after the Supreme Court order in the US? And could the lack of a deal return as an overhang, or the fact that the tariff rate is 15% keeps things manageable? What's your take?
Yeah, so we're down from 50 to 15, so that's great, because 50 was definitely not sustainable. 15 gives a level playing field to all the exporters. So I don't think that there's much concern on that front right now. But yeah, trade deal has been delayed. An Indian team was supposed to have gone, an Indian trade negotiation team to Washington last week. That was postponed. So we're awaiting more clarity from the US, really.
Okay, Shumita Deveshwar from TS Lombard, thanks so much for taking some time out this morning for us. Really appreciate it. All right, let's just get a sense about what's happening in the Middle East when you talk about all the chaos that's inflicted on travel since the conflict began. Many passengers still stranded and looking to get out. CNBC's travel and transport reporter, Monica Petrelli, is right here with us. Monica, what's the situation, the latest?
Yeah, so there are hundreds of thousands of people currently stuck in the Middle East. Most of them in hotels, but some aboard cruise ships. Others choosing to sort of wait out their days in airports as they're hoping for some sort of a flight to develop. But many just taking to social media to lament the fact that they cannot get home, cannot get back to work, cannot get their kids back to school. And really, this situation exacerbated by the fact that some also saying they can hear the sounds of fighter jets and airstrikes all around them. Now, since this conflict began on Saturday, some 21,000 flights have in and out of the Middle East have been canceled. That said, airports and airlines now gradually starting to come back online. I emphasis here, though, the gradualness of this. Dubai Airport saying this week that a small number of flights would start operating. A lot of these are freighters or repatriation flights. Abu Dhabi Airport's also saying it has partially resumed flights, but both airports saying do not come here unless you are specifically called to do so. This is not the place to wait it out. Stay back in your hotel. Now, Emirates and Etihad still saying all scheduled flights are suspended, but again, a limited number of flights. Virgin Atlantic, one of the few carriers outside of the region that has now weighed in saying, okay, we are going to start just a few flights coming from London, connecting London Heathrow to Dubai. Israel's transportation minister saying that its flagship carrier El Al may begin to gradually start flights back tomorrow. Now, this is a bit more than others. We're talking about one flight per hour. Again, this is a very strong if. And UK officials say they're working with Oman to try to evacuate British nationals. Some 130,000 British citizens are thought to be stuck in the Middle East. Now, authorities in the UAE are helping to cover some of the costs, because you can imagine this would increase your travel budget by a lot. But really, this is going to be catastrophic to the UAE tourism industry, not only in terms of these costs, but in the lost profits that it would have from the tourism industry, which in 2024 was around $70 billion to the economy, or about 14% of its GDP.
That's great numbers. And, you know, I was speaking to somebody who was giving me a sense of what's happening in the cruise industry, where passengers are just sitting there, you know, unable to go anywhere because they were linked to this particular cruise and they don't know what to do. And the uncertainty is really harrowing for all of them. And really appreciate all of that reporting. Thanks so much for that, Monica. Indian passengers have, at least some of them, returning home from the Middle East on special flights operated by Indian carriers. The government says 58 flights will be operating today to bring back more stranded passengers. Foreign carriers operating between India and the Gulf region are also undertaking limited operations. The conflict in the region exposed how heavily global and Indian aviation depends on a handful of Gulf hubs. All right, we're taking a short break. We'll be back with lots more. Welcome back. China's most closely watched policy event begins today. The two sessions. CNBC's China reporter Elaine Yu joins us live from our Beijing bureau for more on this. Elaine, what's the latest?
Yeah, so the CPPCC, which is China's first of its two sessions, kicks off today, but that's largely ceremonial. And the main event is the NPC that's opening tomorrow with Premier Li Qiang announcing China's latest economic targets for 2026, delivering its government work report at 9 a.m. And there's debate among Wall Street's heavy hitters on whether China will mark down its growth target. Goldman Sachs thinks China will lower its GDP growth target to a range of 4.5 to 5%. And that will formalize the shift from quantity to quality in terms of growth and also lower the pressure for broader base stimulus. But there are some, like Morgan Stanley, who thinks China will keep the growth target at around 5% like last year. They noted that 2/3 of China's provinces have lowered their targets, but said that the weighted average is still above 5%, and also Beijing values confidence this year because it's the first year of the 5-year plan. So they want to really project that and keep up that momentum. But investors are laser focused on China's fiscal stance. The fiscal deficit ratio is expected at 4%, so that's unchanged. But the broader definition, including off-balance sheet spending, could be up to 12% according to some. And that's really key here because that shows how much Beijing is willing to spend or borrow to really support that growth. We'll also get the 5-year plan that expected to focus heavily on tech, including innovation, AI infrastructure, and also self-reliance, especially when it comes to AI chips. But we're also watching for any potentially new or stronger than expected or refresh language on domestic demand and what that will mean for the economy. And this is not just a short term, but also policy direction for the medium term, and so investors will likely be positioning around those signals. Amatosh, it's back to you.
It's a big day there. Thanks so much for that reportage. We're taking a short break. The Kospi is bleeding today. We'll get you a closer look right after this short break. Welcome back. You're watching CNBC, and this is Inside India. South Korea's Kospi falling into correction territory, leading losses in Asia, with temporary trading curbs activated to limit the fall. Our East Asia reporter, Lisa Kim, joins us now. Lisa?
Hey, Mataj, that's right. I mean, Asian stocks are in the negative territory for the most part today, but it's really South Korean stocks where the risk-off sentiment is very, very pronounced. And this risk-off sentiment coming from the conflict in the Middle East that continues to grip investors. I mean, South Korean stocks are leading the losses. Benchmark Kospi has sank more than 11%. SK Hynix, Samsung Electronics have each plunged around 8 and 11% respectively. And Korean stocks are deepening losses after the index recorded the largest ever daily drop by points yesterday. Korea Exchange, as Amitabh briefly mentioned, activated circuit breakers on the Kospi and the tech-heavy Kosdaq index, halting trading for 20 minutes after the benchmark indexes plunged earlier this morning. And today, the Kospi Volatility Index is also at a historical high. And one portfolio manager who is based out of Seoul told me that even the beneficiaries or stocks that benefited from the volatility in the Middle East yesterday, that's no longer the case today. Defense stocks are down. Oil refiners are down, falling due to what he called a, quote, sell everything, quote, sentiment and panic and forced margin calls to cover losses. I mean, defense name Hanwha Aerospace is down around 10% today after surging nearly 20% yesterday. It was, in fact, one of the few stocks that survived the volatility yesterday, but that stock is down today as we speak. It's down around 12%. And also, it's a similar story in Japan where defense names are down. And meanwhile, Japanese government bond yields, they are doing fairly well. Yields on the benchmark 10-year JGBs have fallen by 21 basis points as investors look for safer assets. And as you mentioned, Amitabh, South Korean currency is also weakening or has weakened. I mean, overnight, it plunged past 1,500 to the dollar. It's a very psychologically important mark that investors keep track of. It's since clawed back some of the losses, but it's still at a low, and it having fallen past the 1,500 mark for the first time in roughly 17 years is something that's definitely on investors' minds today.
Thanks so much for that, Lisa. We're also counting down to the market open in India, and we'll have to wait and see how things shape up there. But at this point in time, it's indicative of the fact that we're looking at GIFT Nifty futures going to be coming, well, close to 400 points down from Monday's close. Remember, there was no trading in India yesterday. The Nifty 50 at 24,865. But the rupee is at a record low against the dollar, breaching the 92, staying up there. And we'll have to wait and see how even the 10-year benchmark government bond yield, which is at 6.7194 right now. The previous close was 6.6753. The yield continuously rising. We've been seeing that for quite some time. We'll watch that space and report back to you in just a little bit. But let's just switch now to give you a sense of what else is happening in the Indian market. Shares of CleanMax Enviro Energy Solutions closed nearly 10% down in their market debut on Monday, giving the company a valuation of about 100 billion rupees, well below its IPO pricing. Weak retail demand weighed heavily on the listing. The retail portion of the 341 million offering was subscribed just 6%, making it one of the least subscribed IPOs by small investors in recent years. The muted debut adds to a broader trend in India's primary market, where most IPOs this year have listed below their offer price amid concerns over rich valuations and soft secondary market sentiment. Now, Kuldeep Jain is the founder and managing director at CleanMax, and he joins us for more on this occasion. Thanks so much, Kuldeep, for making the time. Really appreciate it. I want to start by just understanding. I just want to start by understanding a little bit about where you stand regarding the timing of the listing. It couldn't have been worse. The listing came during one of the most difficult weeks for markets this year. Iran, tariff shocks, the broader risk off, but there was also very low demand during the subscription itself. So how do you read what happened, and really what's the message to investors?
I think the retail demand in Indian IPOs has been incredibly muted. It's about in the zip code of about 100 to 200 crores of demand in any issuance and not more. So for large issuances like us, because ours was a 3,100 crore IPO, that percentage looks low. That said, our IPO managed to get sort of nearly fully subscribed because we had a lot of demand from large institutional investors, such as Temasek, Bain, and many other, domestic and foreign institutional investors, including like say an SBI Life, Panvira, India First Life, and so on. That's the reality. And yeah, you're right. It's never great to debut on the exchanges in the middle of a war. But it is, and the promise I'd made on behalf of all CleanMax employees is, look, we have incredible potential as a company. We are on a journey from a small cap to a large cap, and it's a long, arduous journey from here.
Right. With the hindsight, I just want to take a step back here, Kuldeep, because I just want to understand a little bit about where you see the industry right now. You left a McKinsey Global Partnership to build a solar company when no one in India was buying corporate solar. That was over a decade ago. So how has the business you built changed from those early days to what it is today?
I think, Amitosh, we've experienced tremendous growth. In the last 3 years, it's been 58% year on year. And my life's purpose is to make it impossible for you to say no to green, right? And the thing is that half of all power in India is consumed by corporates. And if they go green, then the nation goes green very quickly as well. And today, whether you're a data center, you're a cement factory, or a chemicals plant, or an airport, you can save 30 to 40% of your power cost by adopting cheaper, greener power. Right, so that's why I think we've seen huge adoption by our clients, but it's early days in that journey. That adoption percentage is still only 7% of all India corporate demand is, through bilateral green contracts. So there's a long way to go.
All right. I know that you've reflected, general confidence on the leverage trajectory. But if you had to explore the group structure, one thing investors are trying to understand is the flow of capital within your group. The parent lends to subsidiaries and invests in projects and SPVs and is now restructuring some entities. Can you just walk us through simply how the group works and where the cash sits?
In the power business, a lot of the projects are in subsidiaries. There's also a requirement from the lenders. And in India, the off-taker of power, like say a Bangalore airport or a Cisco or anyone else, has to invest 26% equity in the SPV which is supplying to them. So most of the operating assets are in subsidiaries of ours. These could be either wholly owned or owned 74% by us and 26% by an off-taker of power. That's how the structure works, which is quite commonplace in the power and renewable energy sector.
All right. I just want to talk to you a little bit about what we are seeing with hyperscalers and the conversation around their contribution in India. You have 1.35 gigawatts under construction, 10.9 gigawatts pipeline, and 43% of your contracted capacity, as I understand it, now serves data centers. Meanwhile, you have this larger global atmosphere where EU carbon border taxes are creating certainly new urgency for Indian exporters to go green.
Yeah.
Your market is, in a way, expanding faster than it can build. So just talk to us about how much execution pressure is there then? If the impact on revenue is, is a concern, let's say if one hyperscaler delays or just renegotiates.
So, Amitosh, we are reasonably diversified. Our top 10 clients account for 36% of our business. So on average, even a top 10 client is 3.6% of our volumes. And, therefore, we do have a lot of diversity in the client mix. But we are delighted that today some of our biggest clients are the global big tech like a Google or Apple, Amazon, and so on. And they are doing tremendous amounts of work in India to not just, offset their India emissions, but also their global emissions, but from India. So that is a huge market. But also the other big market is anyone consuming power in India, because if Make in India can be Make in India with cheaper, greener power. And if it's cheaper, it adds directly to your bottom line. And if it's greener, it helps you with customers whether due to the EU border carbon border tax or due to, it's a good thing to tell any client that, look, I've got a lower carbon footprint.
Right. Just one final question, as we understand a little bit more about not just the sector, renewable push in India, but also about your own model's durability. Talk to us about how the moat holds, because as I understand, you have about 555 customers on 20-year contracts to buy power. Now, that's a remarkable base, but more capital is entering commercial and industrial renewables now, as we've seen in India. So what keeps a well-funded competitor from simply undercutting you on the next deal? Is that a concern for you?
So, Amitoj, what we're proud of is for the last many years, 80% of new contracts we sign are with existing clients. So, in a sense, that base of about 550 clients and about 85% of those clients are AA, AAA or multinationals. So, we really serve the biggest and best corporates. And therefore, there is a tendency to repeat for growth, whether they need it for a plant in another state or the same plant which we are supplying to has expanded. And that diversity of states, offerings, clients is what is our moat. And yes, the market has become more competitive over a period of time, but the growth is so much, Amitoj, that our unit economics, as measured by equity payback, have only improved. So for instance, all projects built in the last 3 years, our equity payback was 2.5 years. Whereas lifetime, that number had been 3.5 years. So, unit economics have improved, volumes have grown.
All right, Kuldeep Jain from CleanMax, thanks so much for taking some time out to give us all that perspective and understanding. Really appreciate it.
Thank you so much, Amit.
We're counting down to the market open in Mumbai. We're back in just about two. We're covering everything that's happening in the conflict. We're looking at the rupee. It's a new low for the rupee against the dollar. We'll be back in just a bit. All right, Indian markets coming online. Nifty 50 as expected, falling from the 24,800 mark from the Monday close to about 24,400 at this point in time, down about, well, closer to 2% as we speak. We're watching this space closely. Remember, yesterday was a holiday and now it is 2%. Yesterday was a holiday. Today, there are expectations that there will be lesser trading, if not a hugely significant amount of lesser trading. And also, you have the rupee breaching the 92 mark, falling considerably. It is a new low for the rupee. We'll have to wait and see whether there will be any support coming in from the central bank, which is in previous times indicated that if it's all about speculation or volatility, they will step in. Traders not indicating anything of that sort right now. It's just the geopolitical uncertainty that's playing into the sentiment clearly. Let's look at some of the movers in the Indian markets today. A quick check on the shares of Petronet LNG. Look at that, nearly 6% down. The company said its LNG vessels are currently unable to safely transit the Strait of Hormuz amid the ongoing Iran-Israel conflict. Petronet said ships headed to Ras Laffan, the loading port of Qatar Energy, are facing material navigation risks. The company has issued a force majeure notice covering 3 of its LNG tankers, Disha, Rahi and Asim. Qatar Energy has also flagged a potential force majeure event, citing regional hostilities. To talk about that and more, we have Rana Gupta. He's the MD of Indian Equities at Manulife Investment Management. Rana, thanks so much for returning to the studio for this conversation. Good morning to you. Let's just zoom out quickly. What are your Nifty levels in both scenarios, given there could be a short war that lasts a couple of weeks at least, and there could be a protracted war that lasts months? Quantify the economic fallout, the Nifty levels.
Let's take the short war first. If the war is, let's say, for 2 or 3 weeks or thereabouts, as our base case is, in that case, we think will not change the market narrative or the trajectory. With some disruptions, probably for a quarter or so, we can return to the pre-war narrative that we were in, where we expected earning growth to become 13-14% and similar upsides in markets. But if the war goes on for a longer time and or there are damages to energy infrastructure causing crude to spike and sustain above $80, then we are talking about downside risk to earnings and perhaps downside risk to some valuation as well. So short war, I think the market is resilient, market and the economy is resilient enough to face, but a longer war will damage earning trajectory as well as valuation.
And where could you see Nifty go in the short term if it's a 1-month war?
So we do not talk about specific market levels, but what we can say is that the Nifty can of course correct somewhat from here. But we have seen during short wars, markets, usually Nifty in the past, has found support about 15-16 times PE levels. And we are a bit away from there.
Yeah, it's down about 2% as we speak. Talk to us about oil prices. In the context that India is clearly diversifying, that's been made clear, and the statement from the Indian government also indicative of the fact that we had already begun that exercise. But how much of an impact could these rising oil prices have on India compared to other nations in Asia that are also dependent on the Middle East?
See, I think the Asian nations like India, China, South Korea, Japan, they're all dependent on oil. India specifically, I think the government, the policymaker, has an incredible job of diversifying, but still, India is a large importer of crude. And if I look at India's current account deficit, in the trailing 12 months, it's over 1%. We think country can take about 1.5%, and that 0.5% is over $20 billion. The math is, India has to pay $2 billion per dollar rise in crude. Therefore, if the crude prices went up by $10 on a year-on-year basis, I think it's okay. The economic country is resilient enough to take it. And that level is 80 because base here is 68.
So where do you see oil going now?
Oh, it's probably the hardest and the $1 trillion call now.
Many are saying that it's a surprise it's not hit 100 yet.
Yeah, so I think what we have learned and understood is the closure of the logistics is the main issue. Production, so not so much as yet. If the Strait of Hormuz is closed, to which India and all other countries have significant exposure, after they run down their inventory, the problem is availability. So I think that can be a major risk going forward. But hopefully there is still enough inventory level. There is still time, a month or so. Hopefully before that we see some resolution. But I think if the crude were to sustain above 80, I think that's for Indian markets, Indian economy, that there will be downgrades from where we are today.
Yeah, let's bring up a couple of different companies related to oil, ONGC, Reliance. What's your, I don't know how much you can speak about specific countries, but what's your take on all of these? Which will be hit, which will gain?
I think tactically the oil upstream companies can do a little better, but I'll make 2 points. First of all, if the crude in a scenario, crude goes to $85, $90 or even $100, it is negative for growth. So in that environment, I do not think even the upstream companies will price in that kind of oil till perpetuity. So I don't think there is much upside. And as far as the in India, there is only one or two pure upstream companies, right? Because other companies have diversified into telecom, retail, so the oil leverage is not that much there. But broadly, even before this war, and certainly after this war, what we are trying to do in our portfolio, it's not so much about oil, but it's having hard assets on the ground. Whether it's aluminum, whether it's oil, whether it's power, companies who have hard assets available at reasonable valuations, buy them. That's what we are doing.
How would you judge the current sentiment in terms of this big question where we don't have a lot of visibility, that war risk insurers have stepped away, and President Donald Trump of the US has suggested that, well, they'll provide the security. Is that something that the market is going to feel like, yeah, okay, this is going to allow the Strait of Hormuz to function at least a little bit, if not completely?
A little bit, yes, but frankly, at this moment, there are no certain answers, right? Markets will gain back the confidence only if they see Strait of Hormuz beginning somewhat normal again. I believe there are 35 ships pass on a regular day, and right now like 2 or 3. If that count begins going up, 10, 12 or something like that, then the market will begin to get some confidence. But our sense is that for that to happen, it will take some time. That's why I'm saying that it'll probably take 2 to 3 weeks for market to get around this, have a clear understanding of what's going to happen.
Yeah, we don't have a clear market direction yet. We'll have to wait and see, as I understand. Okay, so where's the buy, the dip opportunity right now? I know that you're positive on defense and financials. Just give us color on that.
Sure. So defense is something that we liked. And in defense, we like someone which provide electronics, because in that case, you're not specifically going for Air Force or the Navy or the Army. And financials we have liked, because if you take a step back from the war scenario, what happened is that Indian policymakers, they have got these trade deals going. Particularly, we are longer term quite positive on the Europe trade deal, because I think that opens up new markets for India. And as far as the exports are concerned, whether it's jewelry, agriculture, fishery, they're very small companies. The way you can play them is through the banks, which are focusing on SME lending. So that is one area that we like.
You're positive on the credit growth picking up, right? And we're seeing Nifty Finance right now down about 2%. But I wanted to just dive a little deeper in on your understanding around defense, because I know that you're saying that there is, it gets interesting because if you think about electronics that support the defense industry, that you think is a place where there could be gains. But the rider that you've indicated, and that's key, is that for these companies that are not exposed to execution delays in their support to India's armed forces, it's about execution delays.
Correct.
My point out here is that almost all companies are, they face the risk of execution delays in this environment.
Right. So let's say there's a company who's supplying planes, right? They're facing delays. And there is a company providing ships or missiles, they're facing delays. If you have individual exposure to those companies, that impacts the EPS cuts are much higher. But if electronics, so by playing electronics, you get a diversified exposure. For one not working, another will work. So that is a diversity of exposure is what we want in that case.
Okay. Just talk to us a little bit about, I don't know where to start. It's data centers, I think, that we need to focus on, because data center related shares have seen a positive upside because there are very few pure play AI companies listed in India. Yes. Where do you see the opportunity going forward, given you have potential supply chain disruption?
Sure. So I'll just connect it to something that I just said, that we are buying hard assets and companies that help build those hard assets. Data center is part of that hard assets, right? Now, India has plans to go from 1 gigs to about 1.5 gigs to 9.5 gigs over the next 5-6 years. Sure, this war can delay and the execution and cause some trouble. But I think if in the new world with artificial intelligence is going to be the dominant driver, these data center investments are absolutely essential. It can get delayed by a quarter or 2 or even a year. That can happen. The way to play it is that in the data center, the major investments happens in chips, memory, power, cooling system, and metal. India does not have a play in chips or memory, but India has several plays in power systems, metal, and the cooling systems. That's what we are focused on.
Okay. Final question about the IT sector, which has been really where the spotlight has been. I know you have a mixed view, and your point is the large companies, they are vulnerable. The smaller companies, they could gain, particularly those that own IP. How does somebody play this sector then in terms of investment?
Very, very selective. One has to do a little bottom-up study to understand which companies have those IP, because a lot of large companies will also talk about IP, even they have some names for it also. But in reality, they are accelerators because they really cannot charge their clients. They are not transferable. So once you do the bottom-up job, and there are one or two companies will come up with that kind of IP, and they are the ones to back in this kind of scenario. But overall, I think underweight, very selective bottom opportunities.
Yeah, it's a difficult one to assess and make sense of. Thanks so much, Rana Gupta of Manulife Investment Management, once again with us in the studio, giving us that insight. Thanks so much. We're going to take a short break. There's lots more coming up on CNBC. This is Inside India, and on the other side of this break is Access Middle East, where there's been a lot of focus, as you know. Stay with us.